Today, a matter of perspective. Put your game face on. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, just 1 year ago, in fact on January the 29th, 2021, a previously unknown US game retailer called GameStop peaked after surging a staggering 1,740%, or more than 18-fold in just 3 weeks. Wall Street's benchmark S&P 500 index rose another 30% from then after record highs throughout 2021 before finally peaking this year on January the 4th. GameStop's incredible surge and the broader rally in cryptocurrencies, meme stocks and high-growth companies that was sparked by retail investors flooding into markets felt like a high watermark of excess, a moment when a big chunk of the market seemed convinced stocks and other assets could only go one way, and that way was up. But 12 months on, a very different mood has infected the markets at times this week, as Wall Street and the ASX have swung from strong gains to heavy losses within the space of hours. That mood may have felt more like panic. It was another week of severe equity turbulence in which the S&P 500 saw 3 of the biggest intraday reversals of the decade. Microsoft swung 15% in 15 hours and stock volatility doubled. But in the end, for the one last twist of the week, the index rallied on Friday, erasing losses for the week to post one of its smallest wire-to-wire moves in months. It was the final irony for a week in which investors just couldn't make up their minds amid a panoply of warring narratives. On one side, Jerome Powell, son of the enemy, refused to commit to keeping rate hikes gradual. On the other was the booming economy, promising to blot out the impact of anything the Federal Reserve might throw in its path. Beneath it all was dwindling liquidity, the thinnest since the pandemic crisis, making every swing worse and sending traders to the options market for protection like never before. Trepidation with total put option trading surged to a record. Over at investment bank KBW, 2 types of traders stood out to RJ Grant, the director of equity trading: those bailing in order to go bargain hunting later, and those who were just bailing. We've seen sellers who want to get less exposure in case things keep falling in the market, so then they can buy even lower. Grant said, then there are investors who say to us, this isn't good, there's going to be a recession. To Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, the market is likely heading for a stage where volume will continue down as traders wait for clarity. Everybody that wants to sell to take profits has done so. Everybody who wants to put on hedges has probably already done so. And some of the bargain hunters have been out there nibbling around, but they're not doing it with enough conviction to push things high. He said, all 3 of these people are just going to sit on the sidelines and go, okay, I'm not sure what's going to happen here. And yet, the S&P 500 delivered a weekly win on Friday as an Apple-led resurgence in tech helped the broader markets recover losses from earlier this week when the Federal Reserve signaled a steeper pace of rate hikes. The S&P 500 rose 2.4%, the Dow Jones Industrial Average gained 1.7%, and the Nasdaq jumped 3.1%. Apple jumped 7% after reporting quarterly results that topped analyst estimates following better-than-expected iPhone sales despite a drag from supply chain issues. The tech giant also had expected supply chain problems to improve, boosting sentiment on broader tech stocks. Tim Cook is calling out some supply chain improvements for the March quarter, which are calming words heard around the tech world, and much-needed good news in what has been a market storm to start 2022, when Bush said in the note. Facebook, Google parent Alphabet, Amazon and Microsoft all ended the day up more than 1%. As well as bullish earnings, tech was also helped by a fall in US bond yields following economic data, showing inflation continues to gather steam at a time when consumers have pulled back on spending. The latest US economic data on personal income and spending pointed to the persistence of rising inflation. The Personal Consumption Expenditures Price Index, the PCE, excluding the volatile food and energy components, rose 0.5%. After a similar gain in November. The so-called core PCE price index accelerated 4.9% year-on-year in December. That's the biggest rise since September 1983. The core PCE price index increased 4.7% in the 12 months through to November. Remember, this is the Fed's preferred gauge of inflation, up 4.9%, the fastest pace since 1983. Amherst Pierpoint chief economist Stephen Stanley said the most important economic and monetary policy question for 2022 is when and by how much headline and core inflation deaccelerates. The FOMC is likely to give it a few months early in the year. However, if we get to the middle of the year and inflation has not moderated by very much, then Fed officials are likely to ratchet up their concern. I'm very open to the FOMC doing more than 4 quarterly rate hikes in 2022, but I am more inclined to believe that any acceleration from that pace is more likely to occur in the second half of the year, after officials have successfully steered rates away from the zero bound and begun balance sheet reduction. Consumer spending fell 0.6% in December, representing the largest monthly decline since February, and the slowdown in spending, however, was largely attributed to the impact of the Omicron variant. They don't seem to be mentioning the fact that government stimulus has been withdrawn. Spending was hit hard by a combination of the Omicron hit to discretionary services and people's willingness to visit malls, alongside a void left by earlier than usual holiday shopping, triggered by fears of shortages of popular items, according to Pantheon Macroeconomics. Visa was also a big gainer on the day, up 10%, after delivering fiscal first quarter earnings and revenue that topped Wall Street estimates, as stronger cross-border payment volumes bolstered growth. After sentiment shifted away from established payment companies, Visa's relative valuation and growth presents a significant buying opportunity for investors focused on sustainable growth, Oppenheimer said in the note. Robinhood Markets, meanwhile, delivered disappointing guidance on revenue for its fiscal first quarter after users fell in the fourth quarter, but the shares of the trading platform paired losses to close more than 9% higher. Energy proved an exception to the rally, weighed down by a more than 3% decline in Chevron after the oil major reported quarterly results that missed on the bottom line. And Caterpillar, a Dow Jones bellwether, was also nursing losses of more than 6%, as better than expected quarterly results were overshadowed by a fall in margins as supply chain woes drove up costs. Yet, the S&P 500 is down more than 8% for the month, on pace for its biggest monthly loss since a 12.5% drop in March 2020. The broader market index is also headed for its second worst January performance on record. With one more day left of trading, it could end up being the worst ever if it exceeds the 8.6% decline in 2009 after the aftermath of the financial crisis. Adding insult to injury is the fact that January has been a strong gauge for how the rest of the year will play out, a phenomenon known on Wall Street as the January barometer. Since 1950, the S&P 500 has averaged an annual decline of 1.1% after posting a loss in January, according to the Stock Traders Almanac. The market has been under pressure to start the year as investors brace for multiple Federal Reserve rate hikes. The central bank signaled on Wednesday that its first rate increase since 2018 could, and I say could, come at its next meeting in March. That said, there have been some bright spots, as some stocks and exchange-traded funds have managed to buck the overall market's negative trend. Whilst the broader market could be in for some more rough sledding, as the Fed tightens its grip on monetary policy, if you dig a little further, all is not necessarily lost. For example, in the US, Halliburton and Schlumberger are the best performers of the S&P 500 for 2022, rising 36% and 32% respectively. The energy names have been bolstered by a 16% rally in US oil prices. And many Wall Street analysts are also bullish on oil and the energy sector going forward as the global economy recovers from the pandemic. So that could further bolster stocks like Halliburton. In the financial services sector, Wells Fargo is up about 12% this month, boosted by strong earnings and the expectations of rising interest rates. And on the ETF front, the Van Eyck Oil Services ETF and the Energy Select Sector Fund are among the best performers of unleveraged, long-only equity funds, according to Morningstar. The iShares MSCI Chile ETF, which has large weightings in materials and financials, also outperformed in early 2022. Oil prices pushed higher on Friday, and they're on course for their sixth consecutive weekly gain, with the market remaining concerned over supply levels ahead of the latest meeting of top producers. The OPEC Plus group is expected to stick with its plan to increase output at a cautious rate in March when it meets next week. WTI was up 0.81% to 87.31, but gold, on the other hand, was down just 0.17% to 1,790, back below the $1,800 benchmark. But most alarming on a technical basis, it seems as though there's a pattern called a death cross, which is imminent. According to Investopedia, the death cross is a technical chart pattern indicating the potential for a major sell-off. The death cross appears on a chart when a stock's short-term moving average crosses below its long-term moving average. Typically, the most common moving averages used in this pattern are the 50-day and the 200-day moving averages, and currently the 50-day moving average is fixed at $1,805.70. and the 200-day moving average is fixed at $1,805.50. In other words, the current spread between the short-term and the long-term average is just 20 cents. This might be a solid indicator revealing that the selling pressure could take gold to new lows, and if it gets ugly quickly and $1,760 breaks, gold may not see much support until $1,720. At least according to Ed Moyer. Now, over in Europe, the Eurozone's two largest economies had a very different end to 2021 as the region's recovery from the pandemic continued. France beat forecasts with a 0.7% growth in the last quarter, helping it rack up the best annual growth rate since 1969. But Germany stumbled with a 0.7% contraction in the fourth quarter, which puts it on the brink of recession as the latest wave of COVID-19 and supply chain problems disrupt activity. The fourth wave of the pandemic, new restrictions, and high energy prices are a harder hit to the economy than expected. That took the shine off otherwise decent economic numbers from the Eurozone, with Sweden and Spain also expanding solidly. European stock markets have closed in the red with their fourth weekly fall in a row. At the close in Frankfurt, the DAX fell 1.32%, while the FTSE fell 1.17% to 7,466. In Asia, Shanghai was down 0.97% to 3,361, while in Hong Kong, the Hang Seng was down 1.08% to 23,550. More probably bad news as well, as in an effort to reduce debt amid an evolving real estate crisis, struggling Chinese property developer Shimamu Group is considering selling a Shanghai-based hotel to state-owned Shanghai Land Group for 4.5 billion yuan, or $707.8 million, according to Reuters. The company said it will sell an entity whose principal asset is the Hyatt on the Bund Hotel to the Shanghai Land Group. And keep in mind that Shimu, which defaulted on a trust loan earlier in January in 2022, has $1.7 billion maturing offshore and 8.9 billion yuan onshore, according to Reuters. Shimo Group held a meeting with creditors to vote on a $184 million payment extension. Another sign that the property sector in China is wobbly. Elsewhere, Drewry's Composite World Container Index decreased 2.9% to $9,419.50 per 40-foot container this week, but still remains 79% higher than a year ago. That is $6,594 higher than the 5-year average of $2,924 per 40-foot container. Inflation, anyone? Now, in Australia, the S&P ASX 200 dropped 2.6% to 6,988.1 this week, despite rallying 2.2%, or 149 points on Friday, lifting the market out of correction territory in a broad-based rally that saw all 11 share market sectors post gains. The benchmark index reached an intraday high of 7,000 and successfully escaped correction territory as a result. The local market opened 1.3% higher as strong quarterly results from Atlassian and Apple boosted sentiment as their shares jumped in after hours trading in the US. The strong open came despite all three major benchmarks falling in Wall Street on Thursday, weighed down by news that Tesla had pushed back the introduction of new models to 2023. The stock there dived 11.6%. Shares in Imogen surged 10.5% to 31.5 cents on news it will receive a notice of grant from the European Patent Office in relation to its HER-Vax immunotherapy. The company also announced a new clinical trial supply arrangement with Swiss pharmaceutical company Roche. AusNet Services shareholders voted an overwhelming 99.76% in favour of an $18 billion takeover by a Brookfield-led group. The stock climbed 0.4% to $2.59. The price of iron ore edged 0.5% higher to $138.75 a tonne as traders prepared for a pickup in demand after the Beijing Winter Olympics that starts next Friday. So Rio Tinto firmed 4.1% to $113.76. Champion Iron climbed 8.8% to $6.34, and BHP added 2.7% to $46.92. Myo surged 13.3% to 42.5 cents after a parcel of 31.7 million shares changed hands at a price of 45 cents per share. The buyer was understood to be billionaire retailer Solomon Lew, Street Talk reported. All four major banks posted gains of more than 1%. CBA was up 2.02% to 95.67. NAB was up 1.47% to 27.65. ANZ rose 1.48% to 27.47. And Westpac was up 2.33% to 20.63. And Macquarie rose 3.9% to 186.90. Gold miners were amongst the biggest laggards as the precious metal dropped $1,800 an ounce range. Romulus Resources tumbled 8% to $1.31, and Newcrest fell 6.4% to $21.50 after both reported quarterly results. Now, standing back after a painful start to 2022, the option market points to even tougher days ahead for the Australian dollar. A measure of put and call option demand is flashing more bearish signals across tenors for the embattled currency, even as the Reserve Bank of Australia is expected to end its asset purchase program at a meeting next week. Money markets expect the central bank to begin liftoff in the first half of the year and are currently pricing in 125 basis points of hikes by the end of 2022. Now, the Aussie woes aren't unique. All the group of 10 currencies are down against the US dollar, although the Australian exchange rate ranks as the third worst performer. The greenback has surged near an 18-month high on rising expectations of Federal Reserve hawkishness. The Aussie's slide continued on Friday at its lowest level in 18 months after having already dropped about 3.8% against the US dollar so far this year. And that's even as the Bloomberg Commodity Index rises 8.5% in January to a 7-year high. The RBA will need to reflect better than expected outcomes on inflation and employment in its forecasts, announce the end of QE and update its forward guidance on rates to perhaps remove both the reference to low underlying inflation and remaining patient, strategists including Tony Morris wrote in the note on Friday. They actually recommend buying the Aussie versus the New Zealand counterpart as the former benefits more from renewed Chinese stimulus, while the Kiwi is vulnerable if the central bank underdelivers on hawkish market expectations. And ahead, strategists are bracing for further pain as markets digest the fallout from the US Federal Reserve's meeting this week that sets up a historic interest rate rise in March. The volatility in sentiment that has affected markets since the new year shows no signs of relenting, said Lewis Grant, Senior Global Equities Portfolio Manager at Federated Hermes. The collapse in technology and growth stocks has eased, or perhaps paused, only to be replaced with wild swings as investors try to time the lows and bag a bargain. It's not obvious that there are any bargains to be had. And VGI Partners admitted to head-scratching valuations in pockets of blue-chip stocks and remarked at the willingness of the market to pay stark premiums for companies with predictable earnings. The hedge fund manager was caught out by the swift rotation across equity markets, reporting a net return of minus 2.5% in the 2021 calendar year, which it described as very disappointing. By comparison, the MSCI World Total Return Index was up 28.8% over the same period. After the recent investor rotation out of growth securities, we believe many ordinary analog businesses look outright expensive, whereas many advantaged tech-enabled businesses and many of tomorrow's future winners look highly attractive, VGI said in the letter to investors on Friday. And what will the RBA do? Well, the inflation print moves core inflation well past the RBA's forecast out to December 2023, and that will necessitate a material pivot from them at their February meeting next week, said Chris Reid, Morgan Stanley's chief Australia economist. While they won't explicitly guide to near-term rate hikes, they will acknowledge the possibility. Our forecast is for RBA liftoff in November 2022. This print raises the risk this could be a few months earlier. A National Australia Bank also brought forward its first rate hike call to November, but warned the RBA could act earlier, meaning every meeting should be considered live from August. And meanwhile, Commonwealth Bank is anticipating the RBA will upgrade its underlying inflation forecast to around 3% over 2022, meaning the top of its target band. It speculates that two strong wage prints, combined with core inflation above 3.5% by mid-2022, will be the catalyst for a first interest rate rise in August. The RBA have been quite dogmatic in the message that inflation pressures would only emerge modestly and gradually, said Gareth Ed, head of Australian economics at CBA. Indeed, they went out of their way to argue why the inflation dynamic would be different in Australia compared to many other comparable countries where inflation has risen significantly. This looks less credible, with US inflation at the highest level in 39 years and New Zealand inflation at the highest in 31 years. The Bank of Queensland also pulled forward its predictions of the RBA's first move to the fourth quarter, with a risk it proceeds to tighten earlier. It's widely assumed the RBA will end its bond purchasing program in February, also known as quantitative easing, and the February interim reporting season arrived against a backdrop of heightened market volatility. Macquarie warned on Friday that a slowing cycle and hawkish central banks will make for a challenging results period, meaning companies that produce negative surprises will be disproportionately punished. The broker noted that a mid-cycle slowdown is underway, which analysts expect will result in cuts to second half earnings per share forecast. We also have COVID-19 disruptions, rising labour and other input costs, shortages, plus the fading boom in the goods economy, Macquarie said. And Fortescue Metals revealed cost inflation of 20% this week, underscoring the potential corporate impact from rising consumer prices. Macquarie's best long-term ideas heading into reporting season included Santos, Seek, Origin Energy and Amcor. On the other hand, it sees negative surprises for Ingham's and Ramsay Health Care. And UBS analysts also revealed their top picks for reporting season as Adairs, Breville, BWX, EML Payments and Sandfire Resources among its emerging companies universe. It also warned several businesses face risks to their outlook, such as Ordinate, Doe, Kogan and New Hope. So back to that longer term perspective, just as low interest rates provided the fuel for GameStop's rise and the rally in everything from Bitcoin and tech stocks to house prices and vintage car prices, the prospect of rising rates is forcing investors to actually consider what the assets in their portfolio are fundamentally worth. For the last 3 to 4 years, people just say good companies are good investment opportunities, said Dion Hersham, head of Australian equities and executive chairman of Yarra Capital Management. It was almost like valuations don't matter, which I've seen probably 3 or 4 times in my career, but it's always been painful when it unwinds. Although there was a sense of expectation rates would start to go up, I think there was just such a high degree of complacency. Hersham is quick to point out that many investors are still sitting on big gains on a 2-year view. Even with the recent falls, the ASX 200 is up 25% since its recent low in March 2020, while the S&P 500 is up 88% over the period. Even GameStop shares are still up almost 400% since the start of 2020. But Hersham says the 2-year period where it seems stocks could only go up was always an outlier, while this month's correction can be seen more as a return to the reality of volatility and uncertainty. Historical numbers say Wall Street, a good proxy for global shares, will correct, fall by 10% or more every 2 years, fall into bear market, drop 20% or more every 4 years, and crash, fall by 30% every 7 years. I think the key point here is that corrections are the norm. They are not an anomaly, Hersham said. This is what capital markets actually do, and once a rotation like this starts, it's probably got legs given the weight of money behind it. That's in part because of the rising influence of market participants who are not necessarily as focused on fundamentals as institutions typically are. These include passive investors, quant investors, momentum style investors, and even parts of the massive army of retail investors who flooded the market in the past 18 months. Because of this, you can have more movement in both directions. You can have far more rapid changes, and you could have more volatility as well, Hersham says. And I'd add also, of course, the rise in computer trading, which is more significant than ever. The ramifications of rising rates are clearly the biggest factor in the market rout, but they are hardly the only emerging risk investors need to consider. There may be hopes that the Omicron wave has crested around the world, but the renewed pressure it's placed on global supply chains looks likely to last well into 2022, with companies as diverse as guitar giant Fender and electric vehicle maker Tesla expecting little immediate respite. Geopolitics also remains a clear and present danger, from the threat of Russia invading Ukraine to ever-present tensions between China and the West, which in recent weeks has even extended to how athletes will be treated at the Winter Olympics in Beijing starting on February the 4th. Beyond that, there are a series of issues that, while big picture, need to be considered by long-term investors. What will the urgent need to address climate change mean for energy prices? How will the aging of global populations hit economic growth? What do the forces accelerated by the pandemic, such as automation and digitalization, mean for markets? And markets will remain fixated on the Fed's next move in the coming weeks, particularly after Chairman Jerome Powell this week made it clear that the central bank is becoming worried about the prospect of inflation proving hard to tame, and provided little reassurance that the Fed knows how to do that. But for Ben Powell, Chief Investment Strategist for Asia Pacific at the BlackRock Investment Institute, the big picture questions about feed into a much longer and broader debate about where inflation is headed. BlackRock believes the likely rate increases from the Fed over the next 2 years have largely been priced in, and the recent action in bond and equity markets may be somewhat overdone. But zooming out, the investment giant believes the Fed and other central banks have no choice over the coming decade but to learn to live with a much higher level of inflation than what the world has become accustomed to. There are 2 reasons for this. First, inflation will be driven by supply-related factors rather than demand, supply chain disruptions in the short term, but that beyond high energy and labour costs caused by climate change and ageing populations. And second, elevated debt levels around the world after the pandemic means central banks won't be able to raise rates and crunch inflation, lest they also crunch economic growth. It would seem to us that the Fed will and indeed should live with somewhat higher inflation, BlackRock's Powell told the AFR. And that's true whether you're an investor, a central bank, a consumer, and an employee. Clearly, over the next decade, it seems to us it's likely to be the case that a focus on relative winners and losers from a persistently high inflation backdrop is going to be an important part of portfolio construction. It's a view shared by Hersham, who says Australian investors also need to be wary that 2021's COVID-19 earnings boost is likely to fade. I think what we're going to see is the earnings cycle start to roll over. He said it's starting to roll over because of supply chain and cost pressures. It's starting to roll over because financial conditions are getting a bit tighter, the cost of equity, the cost of debt, and confidence is going to start to pull back. And I think what we've also learned is that there were just extraordinary winners through COVID. Like Powell, Hersham says investors need to hunt inflation-resistant companies that operate in sectors with favourable structures and have so-called quality attributes, such as strong balance sheets and a track record of profitability. Yarra Capital hasn't invested in the insurance sector for more than 5 years, but Hersham says now ticks many of those boxes. Two companies, IAG and Suncorp, control 70% of the consumer market. Insurers have shown they can pass through hefty premium rises, and it's one of the few sectors that actually benefits from an interest rate rise. The fact that the industry has been sold off in recent years following a string of natural disasters also means valuations are good. UBS strategist, which is Shellbark, makes a compelling argument that Australian investors are better placed than their overseas counterparts in 2022. The reason why locally focused businesses should outperform this year is simple. The economy is set to boom, he says. UBS tips Australian GDP growth will hit 5% in 2022, ahead of the broader global economy, and as a result, Shellbark likes the financial services, the consumer discretionary sectors, and the energy sector, where 3 to 5 years of chronic underinvestment in new production has left supply and demand tightly balanced and commodity prices strong. Hersham agrees people were too quick to dismiss the sector on ESG, environmental, social, corporate governance considerations. They were way too quick to decide oil and gas aren't necessary commodities. And Shellbark says another clue for investors hunting inflation-proof stocks is to focus on companies that have continued to invest in their businesses in recent years. He argues they will have advantages in being able to avoid many of the input cost pressures which their competitors will face. Those firms that have digitized their businesses and moved online should have lower cost bases, while companies that invested in robotics or automation should be better placed to deal with labour shortages and higher wages. One contrary for investors is how much they need to tweak their portfolios in response to the drama of the last few weeks. US investor and commentator Barry Ritholtz wrote this week that there were several mental traps that investors can fall into at times of stress, including confirmation bias, being drawn to evidence that confirms our preconceived benefits, and narrative fallacy, finding comfort in storytelling to help explain the world. One of the biggest challenges for investors is defeating action bias, the need to do something, anything, to react to bad news. We have a tendency to prefer to do something in the face of uncertainty or confusion, even when the overwhelming evidence suggests our actions, on average, tend to cause harm, and inaction is a more effective course. But Hersham argues the situation is complicated in Australia, where the ASX 200 has always been hugely concentrated around miners and banks, but will become even more concentrated following a series of recent takeovers, including those of Sydney Airport and AusNet Services. While he concedes he's talking his own book, he argues this is likely to be a period when careful stock selection really matters. We've said it repeatedly, this is a year to tread carefully. But it's probably not a year to get out of stocks completely. As BlackRock's Powell says, while interest rates and bond yields are going higher, negative real yields, taking into account inflation, are going to persist for years to come. As such, equities are likely to remain a key part of an investor's overall portfolio. BlackRock's preference is currently for a barbell approach, with cyclical stocks at one end and high-quality, proven tech companies that can profit from the increase in the digital post-pandemic world. In the round, most investors still have the same challenges that they had 3 months ago and 3 years ago, Powell said. How do they retire with dignity? How do they put their kids through college? How do they deal with expected healthcare challenges and so forth? We think a resilient, well-diversified portfolio is a critical part of that. That's as true today as it was 2 months ago, and 3 years ago and 30 years ago. And in the note, Goldman Sachs said it was upgrading its recommendation on energy to overweight from neutral in part because of the positive outlook for the price of oil. Our commodities research colleagues forecast US oil will rise by 16% to $101 a barrel, and Brent by 17% to $105 US a barrel by the end of 2023. In addition, Goldman Sachs energy equity research analysts estimate S&P 500 companies in the energy sector will post 2022 earnings growth of 84%, followed by 2023 growth of 22%, compared with consensus bottom estimates of 37% growth this year, followed by 4% decline in 2023. At the same time, Goldman lowered its recommendations on financials to neutral from overweight. The firm said financials had outperformed the S&P 500 since Goldman upgraded the sector in November. However, the prospect for deaccelerating economic activity creates a more challenging operating environment. And so you can see here there is a lot in play, a lot of movement. And I actually think the point being made about sometimes you just want to do something, anything, is a good point to bear in mind. Sometimes doing nothing actually is the best strategy. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.